Hi, welcome to Control and Compound with Darren Mitchell. I'm super excited about this episode. We've got Cherry Chan, CPA, probably the most recognized real estate investing accountant in the country. She's got all kinds of great YouTube videos, great resources on her website, and we're going to talk about how real estate investors can avoid paying tax or avoid paying the unnecessary tax. So, joining me today is Cherry Chan. Hey, Sherry, how are you doing?
Hi, Darren. Thank you so much for having me on your show. It's an honor.
Oh, thanks for coming. So I've been following you for a long time. I'm excited to get to talk to you. I will tell listeners I did. I have been downloading your stuff for years on your website, realestatetextips.ca. I love the one on 7 reasons why you get questions to ask before you incorporate and what to look at before you go to the U.S. How did you get into this field of or accounting for real estate investors? Because it's probably the question we get asked after why didn't I learn about infinite banking 20 years ago? The second question is, do you know a good accountant for real estate investors? Because across the country we have people challenged with that. So how'd you get involved in that, and what parts of the country do you look after?
So we are out, like as you mentioned, like I have my own accounting firm, and we have a team of 20 something, somewhat people, depending on the season and timing that you asked me. And we work primarily with real estate investors as well as real estate agents, and that's our niche. When I first get started, I started off as a real estate investor. Of course, I went to Waterloo, got my CPA and CA, I wrote my exam, but then at the time, I met my husband, and he essentially introduced me to the world of real estate investing outside of GTA. I think at the time I was working at a corporate job at Loblaw as the senior manager of external financial reporting, like a six-figure job. And I was doing okay, but I was really bored at work. And so every day, I don't know if it is right to say this, but at the time, every day I was checking out the real MLS.ca or Realtor.ca, looking at listing. And so I met Erwin, and I found out that, hey, like, even though I could not afford to buy a different house in Toronto, I could buy somewhere else outside of Toronto, and they could potentially give me significant cash flow. And that's how I got into real estate investing, student rental specifically at the beginning. So I refinanced my home, which is something that I learned from him. And then invest in St. Catharines, which is also something that I learned from him, because I always thought that I have to buy in Toronto and there is no way out of that. And as it turns out, you can buy nearby cities that are much cheaper than Toronto and generate great rent. So that's how I get into real estate investing. But at the time, I was still working at Loblaw, and I was searching on, like, should you set up a corporation and stuff like that. There is no voice out there that would say, hey, like, these are all the factors that you should consider or you shouldn't consider. And soon after that, I joined his team as a self-employed real estate agent, because I was bored at work. Didn't have the satisfaction, so then I joined my husband's team and started selling residential investment real estate to his clients, and I was doing fairly well. But then soon after that, I got pregnant, and then decided that, and also at the same time, I was also searching for realtor specific tax related information, and very few of these information is available. So then I figure, okay, I don't have anything to do during my mat leave other than feeding the baby. So then I decided to look up and started writing blog, and that's how I started my whole accounting business.
So
Long
just
story.
feeding the baby. That's all they
Yes,
take in the first year. You just feed them every now and again. There's
exactly.
no
Yeah.
other problems, no other tears, no nothing. I love it. I'm curious, your student housing. How long ago did you first enter the student housing?
I would say it's 2013 or 2012 August, and we started renting it out 2012 September.
And do you rent the per bedroom model?
The first term, yes. But we have figured out a way to avoid doing the per bedroom model, because per bedroom model means that you have to, if they fight with each other, you have to resolve their conflicts. If if they're not clean, then you have to call each other and you have to set rules. And I don't want to be parents to other kids other than my own kids. So we figure it would be best to rent it out to a group of friends. And we have been quite successful, at least in the market that we're in. We try to go into a different market, so a different city. We are still investing in St. Catharines. We would try to get into Brantford market. We rented it to a group of students at the time, and they still fight with each other to the point that they call the police on each other. And I was like, oh my God, so this is not the city that I want to get involved in. And it's not one time, right? So it gets more complicated. But with our investing in like Hamilton and St. Catharines, these situations really don't happen. I can't explain why. They're all kids. They're still the same age. And in some cities, it's fine. In some cities, it's not fine. So it is what it is.
Very cool. Okay, so what we're going to talk about today is as a real estate investor, how do you avoid paying tax? And we can't avoid all tax, but we can hopefully avoid a lot. And I think really people, and I'm probably included in this, pay taxes needlessly and unnecessarily because you don't know exactly what you're doing. And then you get bigger and you look back and go, wow, I can't believe I didn't know this stuff back then or didn't take advantage of this. So starting from the top, what would be kind of the from a real estate investor perspective, what are you going to be aware of tax wise?
So I think the first thing that I often start is by educating the audience how our personal income tax works. I think it's important to understand that in Canada, you are taxed on, like, at least the personal side. It's a progressive tax system. Essentially what it means is that every marginal taxable income you earn, essentially the higher the income that you earn, the more taxes that you would have to pay. So using an example, between $0 to $45,000, you pay 20% tax. And then $45,000 to $50,000, you pay probably around 23% tax. It's only that delta that would be subject to the additional tax. And it goes all the way up, all the way to 53.5% in Ontario. So anyone who earns anything over $230,000, CRA gets to keep 53.5% tax, more than what you would get to keep. So what are the incentives for people to work hard to make more money when CRA gets to keep more than they do, right? So now that you have a fundamental understanding of how it works, you also have to step back and think about, hey, like, I make maybe $100,000, $150,000, or $200,000 as my base salary day to day, or whatever business that you are engaged in. And if you add another tranche of real estate investment income on top of it, that additional income is going to be subject to a higher marginal tax rate because you already have the base. So are there ways to lower that tax rate? And that's what we're trying to do here. Now, one thing is to understand CRA, or the Income Tax Act, allows you to deduct any expenses, reasonable expenses, that you incur for the purpose of earning the property income. So subject to a bunch of exceptions. Because your accountant or the bookkeeper that you use will not be with you 24/7, you would need to make the judgment. If you're incurring an expense, potentially you can establish the cause and relationship between incurring the expense and earning the particular stream of income. You should keep the receipts, and that would allow you to maximize your deduction. Now, some of them may be subject to the exception, but because your accountant is not with you 24/7, so you keep it, and when in doubt, ask your accountant, hey, like, is this deductible? And your accountant at the end of the year will be able to go through your questionable deduction and then decide whether it's deductible or not. You're smiling. Why?
Well, I hate those meetings with the accountant. I'm like, what do you mean that's not tax deductible? Of course it's tax deductible. I hate those meetings.
Well, then that means you're doing exact job that you're supposed to. You're pushing as much as possible, but it's also the accountant's job to tell you, hey, like, these fall under the exception. So I'm sorry, you may not be able to deduct these. And then there are times that I think that's number one thing. Understand the general deduction deductibility criteria, and then keep all the receipts to protect yourself, because no receipts, no deduction. So those are the biggest thing. And then beyond that is to look at your structure, essentially. And then it goes back to our progressive tax rate in our personal side. Hey, if I'm paying this much tax already, should we be setting up a corporation, or where is the money coming in from in terms of the down payment? If you already have a business, just like you and I, the money comes from our business, and our business is incorporated. So maybe it's not so smart to take out the money to our personal name and then invest in our personal name. So it may be better to set up a corporation as a result. So these are the factors that would help you decide whether there is a different solution to your current structure. And it also goes back to the type of investment strategies that you use. Some people are real estate investor full-time, and to generate the cash flow that they need to support their lives, they often have to do land development. They also often have to do a lot of flipping. And land development, flipping, they are all considered active business income, and therefore is taxed at 12.2% tax. So these are in the corporation. And so these are the factors that goes in. 12.2% being taxed at the corporation level is 10,000 times better than paying 53.5% in your personal name any day. Now, but you also have to understand the intricacy of it too, right? Another thing is, like what we discussed before our call, before we started our podcast, is the use of potentially family trust or multiple people. The progressive tax system on the personal side that I mentioned earlier, the sad part is that the more income you make, the more tax that you would have to pay. But the beauty of this is that every single year, you have a refreshed set of low marginal tax rate. And everyone in Canada has that low set of marginal tax rate every single year. So for those people who have multiple kids that never finish school, they're actually useful at times, and you would be able to leverage them to help you manage the properties, help you do some of the work, do marketing, do bookkeeping, even shovel the snow, mow the lawn. You would be able to pay them some reasonable amount of salary and get that tax deduction and pay very little tax on their personal tax return side, and maybe use it to supplement their tuition as well. So those would be something that you could leverage as well.
Yeah, I think it's like people almost ignore the tax sometimes. And I mean, you're doing a private lend or something that's going to be totally active, active income, and you do it personally and you're in a 54% tax bracket. It's not as sexy as a 10 and 15% if you're giving more than half to the government versus maybe the guy telling you about it is retired and has no income, and they're paying next to no income because he's getting 50 grand a year and his wife's bringing in 50 grand a year, and they're paying little bit of tax on that, and that's it. But if you're already in a high income tax bracket, you really got to be careful of what type of income you bring in, because they take more than half your money. I can't get over that still. It's been a lot of years, but how can the government share be bigger than my share? How does that make sense?
I know, it sucks. And then the other thing that I forgot to mention is that since you mentioned like private lending, we have a lot of clients who invest in private lending as well as some like land development deal. And we often encourage them to maximize the use of TFSA account. I know it's so basic, but people don't take advantage of it because it's tax free, right? And I believe if you have not contributed at all since the inception of TFSA accounts in 2009, and you are over the age of 18 at 2009, you would be able to contribute over 80,000 to your account and generate tax-free income from that account. It's substantial now, and if you religiously contribute every single month, set aside the money to contribute there, it makes a difference. And of course, on another I just had another consultation or a little bit of a presentation to another group. We also talked about investing in like whole life insurance policy, because it allows you to build your equity within your whole life insurance policy tax free. and it increase your death benefit, it increase your cash value, and you can still access the capital that you set aside in your whole life insurance policy by borrowing against your policy. And when you use the money extracted out via a policy loan and invest in the next thing, you are creating an extra deduction. Yes, you have the expense, but you're also earning whatever percentage. You probably know a lot better than me. My understanding is that my policy is earning about 6% dividend within my policy and is tax-free and all that. But if I take that money out and borrow against it, my 6% is still growing, tax-free in the policy, but then I get a deduction on the interest that I write off to earn against my rental income or business income, whatever I borrow it against to earn. So I get like multiple things going for me at the same time. And I think that's the biggest thing, like educate yourself, understand the tax law, and then take advantage of the people around you, especially if they are low income. Try to split income with them, buy whole life insurance policy. So
buy a whole life insurance policy and do real estate. We're going to be best friends, I tell you. This is fantastic. So I want to jump back to the incorporation because we get a lot of questions on should I incorporate, and I know we could spend the whole hour on talking just about that one topic. But if someone's on the fence on whether they should incorporate or not, I know you've got that resource on your website, but just sort of in a couple minute sort of blurb. When should you incorporate and when should you not incorporate? I know there's a lot of gray areas. It depends on your future plans and stuff, but like, is there some rules of thumb? Like if you're only ever going to buy one or two properties, like when should you think of incorporating?
So the biggest thing when I first started this career is that people said, most real estate investors tell me, hey, like you need to have 2 or 3 properties before you should set up a corporation. Otherwise, like it's not worth it. So it's not true. So that's the biggest myth. That 2 or 3 properties have to be in the corporation for you to have the benefit. So then it goes back to the question, like, then how many properties before I should set up a corporation? Like you said, it's very individualized. The number one thing is like, what kind of investment strategies are you using? I think it makes a difference. Like I mentioned earlier, if you're a flipper, you're a land developer, that is active business income. When you report it, 100% of the profit that you make would be taxable. If it's being reported in your personal name and there is no flexibility, you make $200,000, $300,000 from all your flipping business, 100% is taxable. You will be subject to 53.5% tax. Now, that's number one question. If you're investing in those strategies, I would definitely set up a corporation to own those properties, assuming that you're carrying it as a proper business. You are constantly doing that. Now, the other thing is, where is your down payment coming from? I think it makes a difference if your down payment is coming from a small business. Like you would have your small business, I would have my small business. My small business pays 12.2% tax on the accounting side business. And for $100,000, I pay like say $12,000 of tax. And I have $88,000 left for me to invest if I invest through a corporation. But if I have to take that $88,000 to my personal name, I would have to pay another layer of personal tax before I would have the residual amount to invest. So essentially, if I invest through the corporation, assuming that my money is coming from my small business, I invest through a corporation structure, I would be able to use the money that I would otherwise need to pay to CRA as personal tax to invest for myself. So that's fantastic because I'm now using their money to invest for myself and generate income.
We call them 88-cent dollars, right? Do you want 88-cent dollars or 47-cent dollars? Like
exactly.
Take it as a salary or pay the tax and take the dividend. You still get 47 cents, or do it in your corp and you get 88 cents. But again, that's the good news is you have way more to invest and way more to do that. But then you get the tax implications inside the corp. And again, we do a lot of cash value life insurance policies with those 88-cent dollars.
Exactly.
And it's a beautiful place that if you can just pay that little bit of tax. Okay, so how many properties, how long, what you're looking for? What about when you shouldn't incorporate? Like, is there a time when people, like I remember years ago when the accounting firms, and not you, but all the accounting firms, family trust first came out, I'd go see a business owner, and every single business owner had a family trust. They had no idea what they did, and they didn't do anything with them, but they paid a big fee to get one set up. Like, are you see people incorporating when they don't necessarily need to or should?
Yeah, like there are clients who come to us that they already have these misconception that they have to set up a corporation. Like there are clients who are like maybe buying some very low risk property, like a single family bedroom in downtown Toronto condo, which provide them with negative cash flow to begin with, and it's very low risk, and the tenant profile is extremely good, high income couple that is very responsible, doesn't damage your property, and they don't have any properties, like they don't have a business. In those situations, and they're not earning a lot of employment income, so their income tax rate in the personal side could be very low, so there's no risk, there's low income in the personal side, and there's no business to take advantage of the 88 cents on a dollar that we mentioned. Then what's the point of setting up a corporation, right? So those would be situations that you shouldn't set up corporation. Maybe there is also a lot of capital loss in your personal name that you've always reported from losing money in a different market, in the stock market. Then we may actually say, well, hey, like you have these, all this capital loss that you would be able to carry forward to offset against the sale of your rental property. Maybe that should be where you should own the property. So those factors also come into play. And that's why we can't say a one-size-fits-all solution.
Okay, so incorporate again. It's always talk to an expert, right? And that's why I love having you on, because you're a real estate investor yourself. You're an accountant. You're an expert at it, and it's just so hard to find those people. So we got a couple new tax changes have come out, and the big one for flippers. Well, it's big and small, I guess. It depends. Full-time flippers, I don't think it really changed their life too much, but let's talk about the new flipping rules and what does that mean for someone that's going to flip a house? What are the new flipping rules and when do they take effect?
Thanks for listening so far. If you're watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. If you're listening on your favorite podcast platform, please leave a 5-star rating and leave a review and subscribe. And if you are interested in learning more, please visit our website at controlandcompound.com to sign up for a free education session with one of our wealth coaches.
So I think it's worthwhile to mention that you mentioned regular flippers, they already know the rules. They're probably abiding by the rule to begin with. Hopefully they are. So flipper means that you are trading houses. When you're trading houses, you are essentially conducting a business. And when you're conducting a business, the profit that you make from a business is considered business income. 100% of the profit that you make is taxable. Contrary to what people's general perception of selling a house, when you sell a house, if you live in there, it's called like primary residence, you don't pay tax. Or if you buy a house and then you sell a house later on as a rental, the profit that you make is considered capital gain, only 50% is taxable. But when you operate your flipping business as a business, it's considered 100% taxable, so not 50% taxable anymore. And so the rules have always been around. There's like 14, 16, or 12 criteria, I don't remember the exact number, that the prior court case have established, and CRA often refer back to analyze every single transaction. When I say every single transaction, it's every single sales. So you look at the sale of the property and see if you meet the criteria as a business, selling it as a business or selling it as a capital long-term investment. The rules have always been around. It's just fuzzy. Now, CRA has been since 2015. They have been carving out a task force just to focus on auditing real estate investors. Whoever that's taking advantage of the tax law. And they have always been going after those low-hanging fruit. Just like anybody else, we like low-hanging fruit, so as CRA. So they would audit people who frequently transacted selling houses with ownership less than 365 days. They go after those people because they're easy to establish that, hey, like you're operating a business because you're often trading and the duration is short. They often go after those people anyway. But then even if you carve out those segment of people transaction, it could still be a long fight going back and forth. Hey, like, I'm not trading, here is the reason, and I think you're trading. You have to report business income, your tax is 100,000 instead of 50,000, whatever. There's always a long fight, there's a lot of effort. So then CIA came out and said, hey, to make our lives easier, let's do 365 days, because we're going after those high-risk people anyway. If you sell the property within 365 days of ownership, the profit that you make is automatically considered business. I don't care what your reason behind it is, automatically 365 days. Now, they do have some exception available. For example, if you get fired, if you have a personal safety reason from living in the property, if you have a court order, if you are required to move for work reason, if you have a new family joining, those are exceptions. So when you sell, you can still report it as capital gain. Those could be the reason. Now, but other than that, if you, let's say you move into the property, I always use this as an example. If you move into a property and you hate your neighbor, you just hate your neighbor's smell or hate neighbors partying every other day, and you decided, hey, this is really not the place that I want to be in, and you want to sell it within 365 days. Well, it's not a personal safety reason, and it's not a court order, like none of the exception, you fall under none of the exception. So the profit that you make from selling the property, if you do make a profit, would be considered 100% taxable, even though you legitimately live in the property.
So that's a big difference. So if just from a non-accountant perspective, tell me if I'm right. So I'm doing a flip and I think, I'm going to make $100,000 on this deal, and 50% included in capital gains. I'm going to pay roughly $25,000 in tax. And then I go and do it, and they're like, no, that's all income, the full $100,000, and I'm going to double my tax and pay about $50,000 in tax at a 50% tax bracket instead of $25,000.
Yeah, well, absolutely.
That's a big deal.
Yeah, but then, like I mentioned, it should have been reported as 100% taxable anyway to begin with. For frequent flippers, it's just those who are like in the position that's maybe in the gray area.
Yeah, but again, so the flippers themselves, if they have an incorporated business and this is what the active business, they're going to be subject to that 12%. What about, surprised me when I did a land development, you do a big land development company, when you invest in one of their projects and you get that money back, that's coming back as fully taxable income too. They're not a CCPC or a small business. They're a big corporation earning big profits. Is that why it's coming back to me as all that? I mean, that's their business, real estate development. Is that why that money comes back as taxable?
Yeah, so if they're essentially you are signing up as one of their partner, right? If the deal on its own is a land development project, and you're one of the many investors included in it, because the deal on its own is a land development project, therefore the profit that's being made is considered a business income, business in nature. Now, on the other hand, there are other joint venture or big investment project, but that's not structured that way. Their deal could be to buy a couple of like 50, 60 unit building, and then do your usual BRRRR strategy, the buy, renovate, refinance, and rent it out at a higher rent to increase the value. And they still hold the property. And maybe the exit plan is 10 years, and by the end of 10 years, the profit that you make will be capital gain, because the plan is to hold the property long term for capital gain, capital appreciation. So it depends on the particular project that you're going through and you're investing in, and the nature of the intention of the people running the project as well.
Okay, and then I'm sure it consumed you for a couple of years, but a couple of years ago, real estate agents in Ontario were allowed to incorporate. It's called PREC, right? PREC.
Yeah.
So, is there any difference between a PREC and a regular small business? Like, so prior to 2 years ago, real estate agents in Ontario could not incorporate, so it had to take it all as income in the high tax bracket. Huge now that they can incorporate. What's been the ramifications in the industries? Most people that are successful incorporating, and is there any limitations they have in that compared to a regular corp?
So personal real estate corp, at least in Ontario, actually everywhere else, like all the provinces that allow real estate agent to incorporate, they have their governing body. So in Ontario, it's the Real Estate Council of Ontario, so RECO. And so there are specific rules that the PREC has to abide by to follow. It's not like, well, you could just do everything. Now, one of the main things that the PREC has to follow is that the controlling shareholder, the voting shareholder, has to be a licensed real estate agent. So it cannot be someone else. So in another word, you could have shares that's issued to both the spouse and also the licensed realtor. And the licensed realtor has to own all the controlling shares, have all the voting rights. The spouse would not be able to have any voting rights. That's one thing. The other thing is that the corporation on its own, typically you are allowed to essentially funnel your commission through your corporation. That's what's allowed. But because how the legislation is written, there are concerns about how CRA would treat the commission income, because the license is still with the real estate agent himself or herself. So it gets a little bit complicated. But for our clients, majority of them are still operating under the corporation. And the limitation, there's not a lot of limitation. You can do whatever you want pretty much, other than conducting yourself as a brokerage. So you can't trade in real estate according to them. So according to the rule, which is super confusing, because you're a realtor, you're trading as a real estate agent, but that's how they say it. And that's all the only limitation is. Typically, we advise our client to set up a separate corporation to invest in real estate if they are buying a long-term residential home or some flips or any of the pre-construction. We'll advise them to set up a separate corporation for it for multiple reasons. So you're essentially allowed to set up PREC.
So with the PRECs, it's going to be the same as a regular. You can flow that up or across to a holding company. So if you make if you're taking all of it as income, it really doesn't change your life, I guess. But if you've got $100,000 that you made that you don't need to take as income, you can leave that into the corp, take the $88,000 after tax, roll that into the whole co, and now you have $88,000 to go buy real estate and infinite banking policies instead of
absolutely
47 cent dollars if you took it as income.
Yes, exactly. And I think this is the biggest part people don't understand. And people often ask me, what's the magic number? How much do I need to make to set up a corporation? There's no magic number. Like you said, it depends on how much money you need from your business and how much money your business actually makes. It's a combination of those two. It's only when you have enough money and you don't need all the money from your business to support your personal lifestyle that would allow you to, that would make this whole setup make sense.
Yeah, I remember 16, 17 years ago when I incorporated my first year as an advisor, there was no need to incorporate the first year. I just thought it was cool because I spent everything I made the first year and then some. Yeah. So cool. Okay, now the other question we get after, should I incorporate? The big one is, and I put me in this boat too. I'm just scared of the U.S. because investing in the real estate world in the U.S. because of all the taxes and stuff, and I'm like, they got all these rules and stuff. How difficult is it to invest in the States, and what are we going to be aware of if we're looking at properties in the U.S.?
So I think that's it's a big, huge area of practicing in Canada as well. When you buy a cross-border property, there is a huge reporting obligation CRA has imposed. Essentially, they're trying to tax you. The overall objective is to tax you regardless of where your property is located. So they would tax you the same Canadian tax rate whether you invest in Canada or invest in US or invest in Greece. That's the whole goal. So if you were to set up a corporation in the US, forget about all the potential double taxation for a moment. Essentially, you can own your corporation in your personal name, in your Canadian corporation's name. That US corporation own a bunch of properties. If you are the shareholder, sole shareholder, individual shareholder of that US corporation, in your personal tax return, you still need to tell CRA that, hey, I own this particular corporation, and this corporation owns these many properties, and these many properties generate these much rental income, net rental income. And if there is a surplus net rental income, you will have to pay tax on it. That's the bottom line. Now, if there is no income, obviously you don't need to pay tax. If that U.S. corporation is owned by a Canadian corporation, then again, your Canadian corporation is the owner, and your Canadian corporation would have to report that, hey, I own this U.S. corporation, these many properties, this much net rental income, and the Canadian corporation would have to pay tax on that amount. And that's the general premise. Regardless of where you invest, whether it's US or the Greece, you have a Greece corporation set up and invest in Greece property, you would still be falling under that same tax rule. Now, specifically with US has a lot more different types of entities. Unlike Canada, we are super simple. In a way that we have like corporation and individual only, but in the States they have something called LLC, they have something called LLP, they have something called LP, they have everything that you could imagine or not imagine. Now, so what it also means is that you have to be really careful when you invest in the US, because in the US, entities that are available in the US that are suitable for the US citizen and resident, they are not necessarily available in Canada when you are investing in Canada, in Canadian, as a Canadian. Now, generally speaking, I was told by my cross-border specialist, anything with double L, you should not touch. So if someone is helping you to set up an LLC, which is a common thing for local U.S. lawyers to set up for local U.S. citizen and resident for investment purpose, or setting up a business, they often say, oh, let's do LLC because there's tax reason for it. But this is not right for Canadian investing cross-border. So LLC or LLP would not work. LLP is specifically for professional practices, is not available for regular people anyway, but LLP and LLC would not work for Canadian. Now, the reason is just because of the potential of double taxation, and it would be too long for me to go through every single situation, but an alternate structure that's common among Canadian investor investing in the US is to set up a US C Corp. So it has to be C Corp, or that C Corp has to be owned by a Canadian Corp to make it worthwhile, or you would set up something called an LP, a limited partnership. And the cost to set up, depending on who you talk to, in some states, some lawyers, a few $1,000s to $10,000. In some situations, it could be as low as like $2,000-3,000 US as well. So those would be the setup costs, and then there's the filing costs as well.
Okay. Yeah. So I think it would be prudent then, if you're looking to invest in the States, or if you're thinking of buying a property and incorporating, talk to your professional accountant first before you start, or talk to someone that knows what they're talking about before you go all this. Because I can just imagine the nightmare of trying to unwind U.S. corps and LLPs and then changing it. And okay, that's awesome.
Crazy, yes.
And so the next thing I want to ask you about is, the other question we get is when people have Airbnbs, whether on the side or part of their house, or they buy a place for an Airbnb, what are the tax implications that people need to be aware of if you start going down this Airbnb route?
It's a lot. Like, I could only imagine the amount of tax implication for some of these investors, especially with the introduction of these like vacant home tags and all these things. So like, before I get into that, generally speaking, in Canada, we pay there are two types of tax that we need to pay, at least from my practice area. The first one is called the income tax, and the second one is called sales tax, HST. At least in Ontario, it's HST. Now, when you operate a short-term rental business with rental period less than 30 days, you're supposed, it's a commercial activity in the eyes of the Excise Tax Act, which govern the HST. So you're supposed to charge HST when you operate rental business for less than 30 days. And so when you do that, you're required to charge HST on the rent. That's what it really means. I think right now Airbnb would allow you to charge HST directly to the consumer. I think earlier on when they first get started, it's not obvious whether you are charging HST or not, but right now they actually allow you to charge HST and pass HST cost to the consumer directly, which is great. Now, when you operate a commercial business, there are times that you don't have to charge HST when your gross revenue is less than $30,000. It's called a small supplier exemption, but that is also one time attached to your personal name. So let's say you operate as a real estate agent already, and then you also do Airbnb. It's the $30,000 small supply exemption is applied to you as a person. So it applies to all the commercial activities that you conduct. So it's a combined total of $30,000. So if you are already registered for HST as a realtor, there's no $30,000 exemption on your Airbnb. You immediately need to report the Airbnb income and charge HST because you're registered. Now, let's say you are an accountant who earn less than $30,000. Let's say you earn, and it's based on gross revenue. Let's say you earn like $20,000 from your accounting business, and then you earn another $20,000 from your Airbnb business. Then you are over that $30,000. And starting the moment that you're over that $30,000, then you are required to charge HST and register for HST. And as soon as you register for HST, you're always required to charge HST. There's no second year $30,000 as soon as you register.
And then you get to do those fun HST remittances every quarter. Those are a joy. Now, so back to the Airbnb. So if you got someone, they have a T4 job, they don't have another commercial activity going on, and it's $30,000 of profit, right? So for
no, $30,000 of revenue, gross revenue.
Gross. Okay. So yeah, that's not a lot of nights. No. Okay.
So this is not it. So the biggest bomb is that when you sell the property, you may also be subject to HST because now you're operating commercial activity on your Airbnb constantly. Your property all of a sudden become a commercial property. When you operate a commercial property, when you sell a commercial property, you're supposed to charge HST on the sale price. Now, but then at least in Ontario, in certain part of Ontario, certain type of property, people are used to pay HST or not, depending on whether they are HST registered. Now, but with regard to regular residential resale property, people are not used to paying HST. So in other words, when the seller sells the Airbnb property, unless they sell it as an Airbnb business, the buyer may not be willing to pay for the additional cost of HST. So then in other words, the seller would have to absorb the cost of HST on the fair market value of the property. And it's a hidden cost that people don't often consider.
Wow. And again, they find out after the fact when there's no planning to be done at this point. Cool. Okay. So we talked about Airbnb in the US and the PRECs, and we talked about incorporating. What are the other what were the other most common sort of tax question you get from real estate investors that we can wrap up with here?
I think in my like at least today, I don't know when you're going to broadcast this. In my world right now, the biggest news is the Underused Housing Tax Act that was introduced January 1st, 2022 for residential properties, triplex and under, that you own as at December 31st, 2022. There is a filing obligation for people who are affected owners. And the affected owners, although if you read the act, it may say that you are exempted from paying tax, but it's not as simple. If you are someone who owns properties, using a classic example, if you have elderly parents and they're in their 70s, 80s, and they decided to add their kid's name to the title of their home, because the kids don't really own the property. It's still the parents living in it and paying all the bills. They're just adding them just in case if anything happened, they could still handle it, making it easier for the kids to handle the financial affair. Very common. But then the kids are really owning it in trust for the parents, because they don't really own the property per se. It's the parents who are still the beneficial owners, still truly 100% owned by the parents. And in that scenario, the kids are considered the trustee for the parents. And because you're acting as a trustee, now you are considered one of the affected owner, and you have the filing obligation. Now, there is no tax to pay because, the beneficiary of the trust is Canadian owner. So the parents are Canadian citizen and Canadian resident. Then there is no tax to pay, but there is a filing obligation. And that filing obligation, if you don't file for individual who fail to file, is $5,000. And for a corporation who fail to file, is $10,000. Now, another example is Canadian corporation. A lot of our clients use corporations to own residential properties, triplex and under, and they would own the properties and in the corporation, and the corporation is automatically affected owner. So all corporations own these properties would be subject to this particular filing requirement, even though the whole intent initially is to tax foreign owners who leave their residential property vacant and not renting it out. But it ended up affecting a lot of Canadians and Canadian owners who are not required to pay the tax but have that filing obligation.
So the government tried to do one thing and it actually did a bunch of other things and affected a bunch of other people negatively. I am shocked. Shocked.
This is the same with the Toronto vacant home tax, right? Like, how many property is actually vacant, but they're making the entire city of Toronto to fill out the form, which is just stupid. And it's the same with the city of Ottawa, vacant unit tax, same with the BC one as well. So this is all going along with the same theme. What people don't understand is that, hey, because it's called Underused Housing Tax Act, the first response that I get from my client is, my houses are not underused, therefore this is not affecting me. I'm not even opening Cherry's email. And then the second question that I get is, hey, this is the same as the vacant home tax. So I already filed for the vacant home tax. Why do I still need to do this? I don't need to do this. But they're not the same thing. They're just more and more compliance stuff going on.
Wow. Wow. I can talk real estate investing and tax all day. Love that stuff. But I got to wrap up here. So I just want to make sure people can get a hold of you. Sherry, where's the best place? Realestatetaxtips.ca is your website. Social media is the same, at Real Estate Tax Tips.
Yes, absolutely. We're on YouTube, we're on Instagram, we're on TikTok as well, believe it or not. And then we are also on Facebook. We're pretty much on every platform.
On every platform. Well, I tell you, your YouTube videos are just fantastic, because everything we covered today in this episode, if you want an expanded version of that, there's probably a YouTube video that she's out there for Real Estate Tax Tips that are going to give it. I watched your one on the new flipping rules. It was the way you broke it down was fantastic. So thanks for what you do. We appreciate it, and thanks for watching. Thanks for listening. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.